This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our introduction to this subject, we listed out all the different taxes that are involved within our syllabus. We looked at the two main taxes, income tax and corporate tax, which would be fundamental in terms of our exam. We also looked at other personal taxes. We discussed the capital gains tax, CGT as we know it, inheritance tax, IHT. They're personal taxes, they relate to the individual. Then, of course, another business tax. That was VAT, a tax on sales. We may know it as sales tax if you live in the EU or the UK. You'll recognise it, of course, as VAT. Not that we'll be in the EU for very much longer. But we also had one further tax. That was national insurance contributions. And that was a bit of a combination. It was a tax both felt by the individual and also felt by businesses in relation to their employees. But every one of these taxes has got a basic common theme to it. That is, in each of them, and we see here, of course, now in Chapter 2, the first of our technical chapters here, income tax. Now, whether it's income tax, corporate tax, capital gains tax, IHT, you name it, whatever tax it is, there are two basic issues that need to be dealt with. Firstly, we have to establish the amount of income in the case of income tax, a taxable income figure. In case of capital gains tax, a taxable gains. In the case of corporation tax, a taxable total profit. In relation to inheritance tax, a chargeable transfer, a chargeable estate, for example. We have to find out, first of all, what is taxable. Now, that's the first part of our computation, finding out what is taxable. The second part, knowing then what is to be taxed, how do we go and calculate that tax? So here there are two fundamental issues. Computing what is chargeable to tax, first part of our computation, then establishing the amount of tax that will be payable thereon. Now we begin that study of these subjects and those calculations here with income tax. Again, the sensible place to start, although it probably is, certainly here, Chapter 2, one of the most demanding of the chapters that you'll have to deal with within the entire subject. But it's the one that is principal, fundamental within our examination. We know that it will be one of the two 15-mark questions in Section C. We'll also have a significant, no doubt, part of Section A, our objective testing questions as well. So it's going to be a primary subject. In relation to this, therefore, our first task, as we said, on the income tax computation was to establish the amount of taxable income. Now, you can see in the introduction how we make this point. Two main parts to the income tax computation here. The computation of the taxpayer's taxable income. We talk about the taxpayer, each and every individual, whether male or female, whether married or single, whether adult or child. We all exist independently in terms of UK taxation from the day that we're born. And every one of us would have our own income tax computation. Obviously, when you're first born, there's probably not too much income that you're going to have. But we all exist independently. We all are required to prepare and submit our own tax returns, our income tax computations. Calculate the taxable income, and then, as we'll see a little bit later, we compute the amount of income tax that is payable thereon. In fact, there'll be two calculations of tax to perform. As you'll see here, primarily a calculation of the income tax liability, probably the most likely demand in any exam question you see, but also the possibility of income tax payable. So the liability is the amount of tax that is chargeable on the amount of income that is chargeable to tax for a given time period. We'll see in a minute that that time period is a tax year, Now, in relation to that income that we have and that is chargeable for the tax year, what of course exists and looms large for most taxpayers, probably for the majority of taxpayers, is their only source of income is of course employment income. Now, in relation to that employment income, there will be income tax that is deducted at source. So what HMRC do, they get employers to do their dirty work for them. They are the ones responsible for collecting the tax on the amount of salaries, wages, bonuses that are paid over to employees. So pay as you earn is the system that is operated there. And what may happen in an exam question is when they quote a salary, it will always be quoted gross, an annual gross figure. But they may also tell you, and they will have to tell you if income tax payable is what they're asking you to compute, the amount of income tax deducted as source through PAYE, pay as you earn, PAYE. Now that's only going to be relevant to you should they ask for tax payable. So tax liability is the amount of tax that is chargeable on your overall amount of taxable income. And if some of that you have already paid, suffered at source, i.e. through pay as you earn on your employment income, then it will be taken away in determining how much tax remains payable. Always, therefore, especially in OT, objective testing questions, read the requirements. Do they want tax liability? Do they want tax payable? Or even, do they want neither of those? Do they want taxable income? It's a well-worn phrase, I know. Read the question. But when you've got so many questions and when it's objective testing, it becomes incredibly important to make sure that you haven't just thought and assumed what the question wanted because of the information you read in the question, but you actually do answer what is required. So, does the question want taxable income? Does the question want tax liability? Does the question want tax payable? Well, what we've now got to do is see how it is that we put each of those figures together. In terms of our taxable income, this first part of the computation, as we keep saying here, as in this second paragraph, it says, we're not just going to list out each individual source in one single column. We're going to do some analysis columns as well. Now, you might think, why are we bothering to analyse? Surely all we want to know is the amount of income in total that is chargeable to tax, and then proceed to do the tax calculation thereon. There we have a problem. The problem is that different types of income have different tax rates. Yep, we might have known it was never going to be easy. So we've got to break down the income, and I suggest you do this on your pro forma computation, into these different types of income, and then learn the different tax rates that are applicable to them. So what do we have? We have, again, sources of income that I'm sure you will have heard of, like, for example, dividend income. Taxpayer owns shares in companies, and if, well, we hope anyway, receives dividends thereon. That will be one analysis column. A term you won't then be familiar with, savings income. But what that refers to is interest income. Again, something I'm sure that we've all heard of. If you're fortunate enough to have money in the bank rather than the bank having money in you, if you've got money in the bank, then you may, of course, be credited with interest. You may have a deposit in terms of, for example, a building society, a term again that is, again, recognised and well known in the UK, maybe not so well known, again, overseas. But it's another financial institution. If you have deposits in them, those deposits may pay, not very much these days, of course, but interest. That interest income, we, for taxation purposes, call savings income. And then everything else. And everything else goes by the name of non-savings income. So yeah, we've got to get used to the jargon here. We're going to have our total column on our computation. If you look just a little bit further down the page here, you can see that pro forma. We'll have a total column. Now that can be either the final column, as I've included it here, it can be the first column. So it doesn't matter which end of these rows you put the total. Again, in some texts and in some answers, you'll see the total at the beginning, others, as here, you'll see it at the end. It doesn't matter. What does matter is the order in which you list out, according to, of course, what is relevant in your particular exam question, these analysis columns. Very important that from left to right, you get them in this order. As we've just mentioned, non-savings income. Now that is everything other than the two we've very specifically defined. Savings income, interest income, and of course, dividends there. Non-savings income, therefore, what else could there be? Well, obviously, if you look down on that computation, you'll see various other items listed. For most taxpayers, it's their main source of income. That, of course, being employment income. Again, for many taxpayers, not probably the one you're going to see in your exam questions, they only have employment income there. That is non-savings. But not everybody is in employment. Some people may be self-employed. They, therefore, will earn for a given accounting period. This is something you'll know from your accounting studies, of course, I hope. You will have a figure of profit. A profit then, which though acceptable for accounting purposes, will not be immediately acceptable for taxation purposes. And one of the many chapters that we have in terms of dealing with trading profits is working out what is the tax-adjusted trading profit. So for the self-employed, we'll have a tax-adjusted trading profit. Again, 5 chapters dealing with the issues that pertain to trading profits and indeed losses. Others, again, more usually, employment income. Now, that's only one chapter. It's a very big chapter, however, and is a hugely important area. And in some way, shape or form, just as will trading profits, it's going to be assessable. It's going to be examinable somewhere in your exam paper. Looking down this list of items, therefore, there's the trading profit. It will be as adjusted for taxation purposes. There is your employment income, the big two. Both of these, as you'll see in our analysis columns, there and there, are non-savings. You put it into your non-savings column, and equally, you put the figures into your total columns as well. We also see one other form of non-savings income, property income. Now, there are various forms of, shall we call it, investment income. 2 of them we have specifically earmarked on this computation. Here are interest, known as savings income, and here are dividend income flowing through from our share ownership. The other most likely one, you may be fortunate enough to own a property that you don't just live in, but maybe a separate property that you're able to rent out and derives rental income. If you only own the one property, you may let out a room or rooms within that property. But either way, a taxpayer may have sources of property income. Now that again is known as non-savings income, into the non-savings income column, into your total column there. As we know, the other sources, dividends, very specifically defined, again into its analysis column, into the total column. And I've given you a few other examples there of sources of interest, building society interest, bank deposit interest, the 2 most likely. I'll put other interest. We'll see our other examples of interest income just a wee bit later when we look at savings income in detail. But all of those, as we see, savings income, and they all go into our total income column. So what we have here on this computation to begin with is a listing exercise. A listing exercise that is done in the form of this income tax computation. And it's prepared, as we'll see here, for a tax year. Our specific tax year for the exams running from June 2018 through to March 2019 is 2017-18 tax year. Again, each tax year must then record in relation to it all of the income that is chargeable to tax. Now the tax year there, again, if you just look at the preceding paragraph, some very strange dates here, all going back into history. You needn't worry about that, you simply have to know that the tax year 2017-18 runs from the 6th of April 17 through to the 5th of April 2018. I say some very strange dates. You might think it'd be the 1st of April to the 31st of March, but no. Going back in history and to changes in the calendar, indeed, that we had many hundreds of years ago, we talk about this tax year as running from 6th of April to 5th of April. Now here we have the first and very fundamental problem that you're going to face. how are we going to relate each of these different sources of income to this given time period, the tax year? What we need is a basis of assessment, a way by which each of these sources, whether it's from trading profit here, all the way through to any of the sources of interest income, how are we going to relate those sources of income, looking at the periods in which they arise, to this period, the period in which they'll be assessed? We will have a basis of assessment. And in each of the chapters as we go through, we will look in terms of property and other sources of investment income, like interest income, like savings income, our trading profits, our employment income. Each of them will have a way by which we relate that source of income to this given time period, the tax year. And for us, at least for the 17-18 tax year, that's 2017-18. Now again, of course, if you're answering an objective testing question, you're not going to have to do all of this. You're going to have to do an extract from it. And you may not, therefore, because you're not having any workings in on your objective testing questions, not have to stick rigidly to the pro forma. But to begin with, in terms of getting used to the techniques and the different types of income, and critically, the different tax rates that apply to those different types of income, get used to doing it this way. Once we're comfortable with it, then we can start to take shortcuts in answering individual objective testing questions. Of course, in section C, if you're required, as very well you may be, to prepare an income tax computation, then this is the way that you do it. You do it by reference to what you see here at the beginning of chapter 2. What that will allow you to do, therefore, is, again, we just go back, see what we've got. We are able, by listing out all these sources of income, analysing into non-savings, savings and dividend, to bring us down to what will then be our total income. Now, if we look on the pro forma, there we have it, our total income. Of course, where we need to be at the end of this particular exercise is there with our taxable income figure. But now, having got the total income, there are two categories of deduction, welcome no doubt to the taxpayer, that will allow us to reduce the amount of total income down to the figure that is taxable. And these are broken into two sets of deductions. The difference between our total income and taxable income there, we have another little subtotal, net income. Again, a very important term. Now, in the vast majority of examples that you have to do with, total income, net income are going to be one and the same figure. The possible deductions, there are certain payments, qualifying interest payments, where the interest that is paid for the year is an allowable deduction. But there are very, very few examples of qualifying interest. You know, why would most of us borrow money in relation, presumably, to something that we wish to buy? A property in which we live, a mortgage, indeed, on our house. The interest we pay on that? No. No tax relief in relation to the mortgage interest that we pay on the property in which we live. Different set of circumstances if you've got a mortgage on a property that you let out, where indeed, very interestingly from this, the 17-18 tax year, a tax relief will be given in one way or another. You might borrow to buy a car. Again, no tax relief. There are very few examples of qualifying interest. The other situation is about going back to the beginning of the computation. We saw for the self-employed that you may have a tax-adjusted trading profit. Then, though I didn't mention it to begin with, as we just merely listed out our different sources of income, we have a deduction of trading loss relief. Now, when you are self-employed, when you're in business on your own, there's nothing that guarantees that indeed at the end of the accounting period, and for the trading profit loss account for which you prepare the accounts for that period, that at the bottom of that there will be a net profit. Sometimes, sadly, it will be a net loss. Now, we have to adjust the figure, whether it's a profit or whether it's a loss, again, as I said, to make it acceptable for taxation purposes. If there is a profit, then we will find our basis of assessment by which we relate that profit here to this, the income tax computation for the tax year that you are required to prepare that computation for. Here in this example, the 2017-18 tax year. But what you may have had in the past, regrettably, was a trading loss. And for whatever reason, you were not able to utilise that trading loss, use it against other sources of income in the year in which it arose. So what has happened, it's now been brought forward. This is a figure that will be given to you overtly in any exam question. That figure is given to you, this trading loss brought forward. Well, this is where it goes. Your brought forward trading loss goes immediately and only against any trading income of this period. If there is more trading loss brought forward than there is trading profit of the period, then we deduct the loss to bring the profit down to nil, and any unused loss will continue to be carried forward. The detailed study of losses, don't worry, we have a totally separate chapter, chapter 7, in which to deal with trading loss reliefs. But if you were dealing with a period in which the trading loss actually arose, so it wasn't a trading loss brought forward, but this current period was a trading loss rather than a trading profit, then what goes in there? There's no profit, and what you do not do, and this runs true whether we're talking about income tax or indeed the other main tax, corporation tax, where a company makes a loss, you do not put on either an income or a corporate tax computation a bracketed, a negative figure. If there is a loss, then we write in nil as our assessment. Nil, not a bracketed, not a negative figure. Because though it is a nil assessment, for we have made no profit for the period, what we are then able to do with the loss is varied. There's more than one way of using a loss. Clearly, as we've seen, any loss that was unused for a tax year would be carried forward and used here against the trading profit of a future period. But if it were the loss of this period and we had our nil assessment there, an immediate use, if we wish to make it this way, would here in this term, pretty general term, other trading loss reliefs, we could deduct it from the total income of this period. So here, one possible use of the loss that lies behind that nil assessment, all of which, again, don't panic, we will see in chapter 7. But that loss that lies behind that nil assessment may, if you choose to make the claim, be set off against any other total income of the period. Just because your trade has made a loss, so there's nothing to assess, doesn't mean to say that you have no income. You might be fortunate enough to have those different sources of investment income, whether it's property income, whether it's dividend income, whether it's interest income. You might even, as well as being in being in self-employment and having a trading income figure to include, you might also have some maybe part-time employment. So yes, you could make a loss, but still have total income chargeable to tax this period. In which case, other trading loss reliefs that we'll see will target total income. Details of which, as I keep reassuring you, is later in chapter 7. But that will bring you to net income. And then what we always have to deal with is a deduction of a personal allowance. Now I said there, we'll always have to deal with. There may not be any personal allowance that is in fact available to a taxpayer. For most taxpayers, we don't have a problem. The personal allowance is a level of tax-free income that individuals are granted in each tax year. For our tax year, 2017-18, as you may have already noted up here, the amount given is $11,500. All of which details of rates and allowances, by the way, of course, are on your rates and allowances pages. made available to you in the examination room. But for the 17-18 or 2017-18 tax year, it's £11,500. Now, the vast majority of taxpayers will all not only be entitled to, they'll get that personal allowance, and that will serve to reduce here their income. But of course, and now having got our deductions of qualifying interest and other trading loss reliefs, as well as now the personal allowance, what you see here is that as well as, of course, going into your total income column, those deductions have firstly been made against your non-savings income. Remember this first column? Non-savings income. Now, in the vast majority of occasions where you will be preparing an income tax computation, the non-savings income is likely to be bigger than the personal allowance, more than £11,500. In which case, you take away your personal allowance and you come down to your taxable income there for non-savings, and of course, eventually to your total figure as well. But what would happen if your non-savings income was less than £11,500? Now you'll see the reason why we have the order of these columns. Because any unused personal allowance after deduction from non-savings income will then go across and be deducted from any savings income. If we were able to eliminate all of the savings income with this extra personal allowance, and there was still some left over, again, not that likely, but that then would go in turn to be deducted from your dividend income. So that's why we have those columns in that order, because deductions from those sources of income are done in that order: non-savings, savings, and dividend. And then, having got the taxable income, when we come to then the second part of the calculation, computing the tax liability and, if necessary, the tax payable, we will then have to know what tax rates to apply and what order in which to deal with the taxability of our taxable income. And guess what? It is again in that order. It will be non-savings, followed by savings, followed by finally your dividend income. So that again, the reason as to why we set the computation up in this format. So through the chapters that follow, each source of income will be looked at to determine how it is and what figure it will be that will be allocated to any specific tax year's income tax computation. The bases of assessment must be learned. Some of them are very obvious and very simple. We simply look at the actual amounts received in the tax year. Remember the tax year running from? 6th of April through to the following 5th of April there. Others are more interesting, shall we say. Now you may realise that when I use the word interesting, that's code for difficult there. But we prefer a challenge, don't we? But others, very simple, like an actual receipt basis. But as we come to each source of income, then we'll go through and deal with the basis of assessment as to how we relate all of these different sources of income here to this, the income tax computation for this time period, for us, for this year, the 17-18 tax year, and how, where we have those sources, not only do we have the total, but we have in order from left to right across the page, non-savings, followed by savings, followed by dividend income. Again, we only need to use and set up those columns where appropriate. If doing a section C question, before you put pen to paper, or before you put anything on your computer, if it's the CBE exam that you're going to be doing there, then you will already have recognised from within the question which columns are required, and you will only prepare those. Finally, down the bottom here, we said about employment income and having tax deducted on it through the pay-as-you-earn. Again, more of that later, the PAYE system. But any employment income that you get will always be included gross, i.e. before the deduction of the tax source, the PAYE, and it will always be stated gross within the question. So any salaries you get will be gross salaries. If they say taxpayer had this annual salary £40,000, in brackets PAYE £5,000, then you know that that £5,000 is the amount of tax collected by the employer in relation to the income paid out to that employee, i.e. on their £40,000 annual salary. Into the computation, we put the £40,000, the gross figure. At the very end of the computation, as we'll see in our next lecture, we will then, from any tax liability that we compute, deduct the £5,000, pay as you earn, income tax deducted at source. As we've just made important reference to, any of our deductions from our total income, be they the qualifying interest, be they loss reliefs, or then from net income, the deduction of the personal allowance, we will do them in that order. Again, taking it away from, firstly, non-savings income, then savings, and finally dividend income. You may remember that I said in relation to your personal allowance that although we all start off as UK taxpayers with an entitlement to a UK personal allowance, an amount of £11,500, I feel sure you recall, that those taxpayers who are fortunate enough to have very high levels of income, we will specifically define what those levels are, may suffer a reduction in or a complete loss of that personal allowance because of the high levels of income that they have. But more of that later. So, before we come to our second lecture together, therefore, again, I forewarn you this very long chapter, get your head around that income tax computation. Know how to prepare it. Know what goes where on the computation. Understand the analyses that we do. Get used to that. You should be able to sit with a blank piece of paper and set up that pro forma computation for yourself, should you be required to do it within section C. Okay, join us again therefore next time, where having got the taxable income, as we said, we'll then move on and see how it is that we compute, firstly, our income tax liability, and only if we are required to compute it, our income tax payable. I look forward to seeing you again then.